Well, one of the biggest challenges of a Tuesday morning panel is after our late night on Monday night, it takes a while for people to roll in, so they will eventually. First of all, I'm Ross DeVol. I'm the Chief Research Officer at the Milken Institute, and I'm going to moderate the session this morning on the U.S. overview. Will the economic tailwinds continue? And we'll debate that. The presidential election didn't quite go as anticipated last year for a variety of reasons. This audience might have been skeptical if someone would have predicted that Trump was going to win the presidency a year ago. I can't say I did at the conference last year, but by June, I was predicting that. That's a whole different discussion. So we're going to discuss what are going to be the top policy priorities of the new administration. There was a candidate Trump. Will there be a President Trump who might alter his policies somewhat relative to what he campaigned on? And it does appear that the economy entered 2017 a bit stronger, although we've seen some recent weakness in some data. Former headwinds are now sources of growth. Oil prices had fallen, and that had caused oil exploration to decline quite significantly, but that's beginning to recover. We're seeing fairly strong signs that global growth is returning, and high inventories are no longer restraining growth. Consumer spending and housing have been kind of the strongest areas of the economy, and we'll talk about whether or not that continues, what happens to job and wage growth, and will animal spirits return in the sense not just in financial markets, but will boards and CEOs be willing to commit capital to physical investment? So we'll discuss those agendas. We might also touch upon the administration's rhetoric on trade, for example, with Mexico, China, maybe even Canada, I guess, because we have those new tariffs on lumber that have been put in place. So we'll touch upon that. But we're going to really try and see, have the fundamentals of the U.S. economy improved? Could I see slide 30 just to kind of set up the kind of disconnect between some of the soft data versus the hard data? It's slide number 30. Yeah, so this shows you retail sales and capital goods orders, percentage change from a year ago on the left axis, the two lines there, and then the two bars. The two lines show you consumer confidence and business confidence, and you can see that consumer and business confidence have really taken off over the past few months, and retail sales and other kind of hard measures of the economy have not done quite as well. So we're fortunate to have a panel that can address all these issues. Let's get to the introductions, and I'm going to do it in alphabetical order. Yes, there still is alphabetical discrimination that occurs. To my extreme right, not necessarily reflecting his views, is John Chen, Executive Chairman and CEO of BlackBerry, and Alan attests to the efficacy of the software that his company produces because he still carries around the BlackBerry. He sneaks it in his pocket and pulls it out. To my immediate right is Francisco González Díaz, CEO of Bancomext. Glad to have your perspectives in joining us. To my immediate left, Vasant Prabhu, the Chief Financial Officer at Visa Incorporated. Beside him is Stephen Rattner, Chairman of Willett Advisors, been known to be in a few administrations, might have been in the past one a little bit, helped bail out the auto industry. And the last panelist to the left is Alan Schwartz, Executive Chairman of Guggenheim Partners. So let's get all the panelists into discussion as quickly as possible. If I could have slide 16 just to kind of pose this first question, just to remind people, if you look at what's happened to the S&P 500, NASDAQ since the election, there's been a dramatic increase in valuations. Alan, if I could, financial markets and investors have reacted favorably since the election based upon the administration's new agenda, and it still is an agenda because not much has been really implemented. Deregulation, tax reform, infrastructure investment. Equity markets pulled back a little bit in recent weeks, but they seem to have gotten their underpinnings again. The Affordable Care Act, repeal and replace, didn't quite go through the House as quickly as anticipated. Do you think that markets have kind of overreacted? Did they get ahead of the political reality in Washington? Maybe is another way to phrase it.
Yeah, I think it's a good question, but I want to take a step back. I think that my own personal view is the markets have been more 70% fundamentals and 30% expectations, but it's been confused because of the timing. And what I mean by that is in 2016, we had kind of a mid-cycle correction globally. We had a slowdown, and we started to see late summer into the fall many, many signs of kind of a coordinated pickup in global growth. You saw it in China, you saw it in Europe, and you see it in the United States. But between Brexit and the US election, the fundamentals were kind of on hold as everybody was trying to figure out what was the geopolitical risk that they had to think about in the market. So when the election happened here in the United States was a surprise. Overnight markets were down a lot, but I think there was a lot of pent-up buying based on fundamentals is my own point of view. And that pent-up buying came through. So the first thing people see, all the pundits say, let me read the headline, Trump won, let me look at the market's rallying. They must really like this new administration. So I think it was more fundamentals. As the administration has developed, as I think that some more thoughtful advisors seem to be taking the helm over some other parts of the administration, I do think there are aspects of what is being talked about that especially while fundamentals are still relatively supportive, people are getting more optimistic about. And in that category, I would say I think it's much more, my own personal view, much more about deregulation. Although I believe state and local is the biggest inhibitor on regulatory drag on the economy, but there is some, especially if you look at things like the FCC, and then some on tax policy, et cetera. But there may be a little ahead of itself, but I actually think it's not as driven by policy expectation as people are saying.
Right. I know our chairman, Mike Milken, told his family office after the market went down initially, he said to buy everything you can get a hold of, because a lot of this is just relief that the election is over, regardless who would have won, it would have gone up. Francisco, let me turn to you. Candidate Trump ran on a platform opposed to the Trans-Pacific Partnership. He said NAFTA should be revoked. After leaking that they were going to announce they were pulling out of NAFTA, it appears that calmer heads have prevailed and they're going to attempt to renegotiate NAFTA. So my question to you really is, could you explain why the U.S. still really needs NAFTA? Have there been benefits for the U.S. from NAFTA?
Of course. Let me thank you for inviting me. And let me tell you that's really important. The first T I would like to talk about. I would talk about 10 T's for this subject. The first T is trade. The trade that has evolved in the North American region has brought the U.S. many, many benefits. Why do I say this? Because the US, Mexico, and Canada have really started a good relationship. We are selling all around made in North America goods, in North America services. And in this sense, we have developed a huge platform of trade. But let's remember that the other T, technology, has brought also very much part of the unemployment in the US and in Mexico. When you develop also the trade, you have also technology, and the technology brought those gaps in the talent needed, the other T, for really manage and use the machines for the new productivity needed for the trade that we are really roaring on that. Also, in this part of the T's, we see that Twitter and trust are part of this information misunderstanding, misinformation, and we have really a very good trade, we have very good technology, but the information as it's managed by Twitter, this brought also mistrust in many things. But you have to see through the other T, transparency and truth, what's really happening. You have to review, and you can see via another T, travel, what's happening in the rest of the world. When you see that trade, the North American made goods are everywhere. it's made in the US or in Mexico or in Canada, you see that the footprint brought really good things to the US. You can see not only McDonald's, you can see also cars, American cars in Africa, in China, in many parts of the world, and this is part of this trade that has been developing at the border, at the very center of the countries. And also, you can review that with the development of new talent and new tomorrow, there will be no truncated times. You will see that everything will combine, and you can review with this transparency that trade for the US has been very, very good because of NAFTA.
Right, we'll have some examples here in a little bit. John, let's stick with the NAFTA theme for just a while. You're a Canadian-based organization. A lot of your customers are in the U.S. So you're in a very interesting position on trade relations. How would you view the reopening of NAFTA, and what would you like to see come out of the negotiations?
Well, first off, I'm American.
I understand that.
Okay. I say this because after this conversation, I may need to be a Canadian.
Yes. They have a very liberal immigration policy if you have high skills.
I think I'll be okay. I think it is true that the NAFTA agreement does need some refinement. I think the way that the narrative is going on publicly, it sounds like that we want to make big changes. We cannot make big changes. I mean, the United States actually cannot afford sharp changes on it's like turning a car at high speed in a very, very fast way. I caution on that. I think there are areas that are now being looked at in services and IP that is probably worth a good discussion. However, I also want to warn one thing. I know that if you are favoring jobs, and which is the principal underpinning of this, you're probably going to hurt innovation as a result of that. And the question is it a wise thing to do on a long term? And so when I think about those negotiation or discussion, if we focus on lumbar, if we focus on dairy products, you focus on all those things, I think we're focused on the wrong end of the stick. I think what we need to focus on is not whether a farmer will lose his job or not lose a job, but to create more innovation technology job. I think a better IP policy and a better services policy is needed. The last point I would like to make is I think the administration seemed to be reactive on a singular basis. You look at an industry like the pharmaceutical industry. We didn't like the fact, or our pharmaceutical company didn't like the fact that the Canadian IP law allows generic drugs to be more flourished. And so because of that, now we want to open up the conversation about IP in general. So I actually think that's very short-sighted, and I hope that cooler heads, which you call about, get together and become more productive that way.
Well, I think some recent additions to the administration would suggest they're moving in that direction. Could we have slide 6, please? Vasant, at Visa, you have an opportunity to see U.S. consumer spending patterns virtually before anyone else. I don't know if you can see them before Amazon does or not, or after. Which happens first?
Nobody sees anything before Amazon.
Yeah, I suppose that's true. But you find out very quickly after that. It appeared earlier this year that consumer spending was fairly robust, but there have been some weakness reported in official government statistics in recent months. Should we be concerned about consumers pulling back from your perspective?
Well, as you know, at Visa, there's about 450 to 500 million Visa credit and debit cards in the US. And every quarter we report on how much people have been spending on those cards. And if you've been looking at that for the past several quarters, spending has been both strong and steady in terms of growth. So credit card spending has been growing in the very high single digits, almost low double digits, all the way through 16 and into 17. We just reported calendar quarter 17 results a couple of weeks back. So debit cards, mid-single digit growth, again, very steady all the way through 16 and into 17. So you look at that, and clearly you would not see a change in trend. If anything, if you look at the last 4 to 6 quarters, you've seen a broadening of the spending base. What we've seen is in the early days after the financial crisis, as you might expect, affluent households with the recovery of asset values drove a lot of the growth. But in the last 4 to 6 quarters, it's really middle-income households that have been growing faster, in fact, than affluent households. The other thing we've seen more recently in the last 4 to 6 quarters is in the first few years after the crisis, it was the large metros, top 10 metros, that drove 75%, let's say, of the growth in spending. But in the last few quarters, it's been mid-tier cities and smaller cities. And we've been on record saying that the last holiday season in 16 was the best in 5 years. So you put that all together and you say, US consumers doing just fine, no change in trend. So how does that reconcile with what we just saw on the GDP? Just a few things to consider. First of all, our data is real time and unadjusted, so we're not in the prognostication business. So as you know, the GDP has seasonal adjustment factors and all that, and I'm told, and you would know this better, that those haven't been particularly reliable in the last few years, so we'll have to see how much that had a factor there. And then we're not in the sampling business either, so the data we report is based on actual spending on these 450 million cards. I know the GDP data, at least at this stage of the game, is based on household samples, which run into the thousands. A couple of other things, though, to note. One, you don't see durable spending on credit and debit cards. So if it's cars, autos, as you've been hearing, that's causing some of the numbers to be weak. You wouldn't see that in our numbers. One other thing to point out on government statistics, since a lot of people rely on them, something we've been scratching our heads about is the shift to e-commerce has been massive and significant. For example, on Visa credit cards, 40% of the spending today is e-commerce. And so the question we have is, are the traditional sources adequately capturing? We know bricks and mortar retail is in decline. We know the e-commerce sites of bricks and mortar traditional retailers tend not to do as well as pure plays. We wonder if that has something to do with the data. But in any case, we'll wait and see. I've been hearing from people that the second quarter numbers may be in the 3s, and then you average the 2, and you're back to 2% growth, and no change.
Where we've been
in trend.
since the recovery started.
Exactly. So I'd say from what we're seeing, the consumer is not behaving like there's anything different.
All right, I appreciate that. Steve, candidate Trump ran on a platform of bringing jobs back to America. In fact, that got him elected in the key states of Pennsylvania, Ohio, Michigan, Wisconsin, and put him in the Oval Office. But the question really is, how material of an impact can his policies have in bringing manufacturing jobs back to America?
I think the ability of any president to bring manufacturing jobs to get back to America on terms that we would all find attractive is very, very limited. Essentially, what's going on is that other countries, Mexico being certainly one that's prominently mentioned, but by no means the only country, have just gotten better and better at making things that previously used to be made here for any number of reasons, but among them being that we thought we could make them better. And the fact is, in the car industry, which I spent some time working on, if you talk to General Motors, if you talk to Ford, if you talk to Chrysler, they would tell you that they get productivity at least as good from their workers in Mexico as they do from their ones in the US, and they pay them roughly $7, $8, $9, $10 an hour versus our $55 an hour for the old line workers, a bit less for the workers in the non-unionized plants in the South. And so you simply have a situation where the world has kind of moved on and other places have gotten good at making stuff. This obviously happened in textiles in the past, where we essentially have almost no textile industry. It happened in furniture. It's happening in all kinds of basic manufacturing. And it's also happening to some degree in advanced manufacturing. They are starting to assemble citations and Lears in places like Mexico and China, aerospace work that we thought could only previously be done here. So it is a little bit like King Canute trying to hold back the tsunami. And I'm not saying that about President Trump specifically, but about any president who tries to do this. It is simply part of the evolution of of globalism. And you could probably go the other direction, put on the massive tariffs, shut down the borders in one form or another, and recapture a lot of those jobs here, but at enormous cost. There was one estimate recently from the Peterson Institute, which is very much a free trade group, so you can take it for what you will, that if you shut down pickup truck production in Mexico, it would add $3,000 to the average cost of a pickup in the United States, and those presumably are bought heavily by people who might have voted for Mr. Trump, or certainly middle-class, working-class types of people. So you could bring them back, but the cost at which they would come back would be so enormous that and so many other kinds of consumers would lose. Let me, if I could, just say another word on jobs slightly more broadly, which is, I think everybody talks about jobs, and jobs, I think, has kind of become a shorthand for a different kind of a problem. We have a lot of jobs in this country. We have a 4.5% unemployment rate. There was something like 15 or 16 million jobs created over the last 8 years. Last month wasn't so great, but we continue to basically tick along, adding a couple 100,000 jobs a month, and the unemployment rate periodically ticks down a little bit. And also what's happening, before someone points this issue out to me, is that the labor force participation rate, which had been dropping, it's not nearly back to where it was, but it has turned up a bit. So there is some sign that people are coming back into the labor force. So we have a lot of jobs. What we don't have are jobs that pay the kind of wages that the jobs that have left or are leaving paid. And part of what I think is at the root of the discontent that you see in the places that you referred to, Ross, is the fact that people, when a manufacturing plant closes, someone goes from making $20, $25, $28 an hour to making $12 or $15 an hour. And that is a very destabilizing place for someone to be from a pure emotional and as well as financial point of view. And that to me is the nut of our challenge. And it also is reflected a bit in our growth rate, in that we are growing. We are at this 2% growth rate, but with labor force, the size of the labor force not growing that much, with productivity being very weak, which is a subject we should talk about, it is, I think, other than maybe some tiny little burst, virtually impossible to get growth above 2%. So this is where we are. It's not the worst place you could be, but it's obviously far from the best place you could be.
Thank you, Steve. Any other observations on where you think the U.S. economy is today in terms of the underlying growth rate?
I think really that Stephen is right in all of his remarks, but I would also put the development of talent, with the new education for closing the gaps with the new technologies. If you want to have better salaries, you need really to move on developing new strategies on education. For the US, for Mexico, I would love to see the US jumping to these new jobs and technologies and not following the path of manufacturing. Really, the US is very good, for example, in agriculture. We're the #1 buyers of grain, of soybean and wheat, but we would love to see the US jumping ahead with all the technologies in California, in Massachusetts, and so on. And so we can really have a very competitive NAFTA. The productive areas in manufacturing are in Mexico, yes, but we would have to engage with other kind of specialties in Canada, in the US and Mexico, so we can evolve and be really a region that can compete with the world.
Can I have slide one? Just want to touch on the single-family housing market a little bit. The U.S. recovery in housing hasn't been stellar. We're not back up to the previous levels, but many would say that was an aberration to begin with. Let's get into a little bit about what's affecting these housing markets. Vasant, you've done a lot of work in looking at millennials and their thinking about housing. Could you kind of give us an update on just where the housing market stands and how millennials fare in that?
Yeah, and there's been a lot of talk about whether millennials are different than their parents, and will they buy homes like their parents did, and are they more inclined to rent? You know, our chief economist has done some work on this, and in simple terms, you know, his view is people are overreacting. The median age of millennials now is about 27, and there's a lot of work done on when people buy, you know, first homes, looking at spending and all that, and it's between 29 and 33. So, you're not quite there yet in terms of, and that 29 to 33, he tells me, every decade that moves up by a year. So people are doing things, they're staying in school longer, they're getting their first credit cards a little later, they're, obviously getting, their jobs a little later, and getting married a little later. So we're not really at the point where millennials are out there, at an age level to be very much in that starter home age group. So we would say it's too early to tell and declare that millennials in some way are going to behave differently. If anything, spending by affluent millennials, as we've looked at it with the data we have, is not very different than spending by affluent boomers, surprisingly. And there's some interesting things in there that, we can talk about another time, but it's the less affluent millennials that are showing some financial strain, and the student loan questions, and then there's an affordability question. So if you're a millennial in California, 9 out of the 10 least affordable housing markets are here. You may want to buy a home, but you're dealing with the realities of affordability. So, our view is that's not an issue. The bigger issue, perhaps, and others here might know more, is, in a couple of years or more, millennials are going to be in the starter home mode. Boomers are going to be in the downsizing mode. Where's the market for the big suburban homes? Who's going to buy those? Doesn't seem to be clear yet whether that's an area where there's a problem.
Any other comments on housing, quickly?
I think housing usually follow where the jobs are, and unfortunately, where the jobs are being created are in the innovation sectors, and those jobs drove the housing price up. This is one of the reasons why the starting out millennium are having a hard time in acquiring real estate. So I think that's a problem a little bit more profound outside the United States, but it's showing up in the United States in selective cities and counties. So we got to start paying attention to that too.
Well, let's stick on the technology theme, John. That's been one of the key underpinnings of the U.S. economy. So my question is, can that continue? Maybe let's use your company's shift into developing software for autonomous vehicles as an example. Is that something that can power the U.S. economy?
Well, yeah. I mean, innovation is really about kind of undoing what's old and doing what's new. And so, yes, the sector I'm in could use as many talents and has created as many jobs that we should actually find people for. So I think the innovation cycle is still very strong, and it's probably going to be very strong for the foreseeable future. I think a bigger sector of growth, and from my perspective, is in healthcare, and in the service sectors of the healthcare. And it's not a big secret that we need about 300,000 more nurses in the United States, for example. And it seems like that number is constant every year. We've been talking about 300,000 10 years ago. We're talking about 300,000 now. We just for some reason we're not building nursing schools, or a school that teaches people to be a nurse. We're not really building enough hospitals around the country. So I think that sector will create a lot more jobs than tech. But tech is getting into part of that also. So those two sectors I feel very good about.
All right, very good. Let's go to slide 2. Let's take a stab at capital spending. Corporate profits are at record levels. U.S. businesses have not been devoting surplus funds to capital investment. If anything, they've been increasing their stock buyback programs. So my question really is this: why haven't animal spirits returned? What's holding it back? Alan, maybe I could ask you to take the first stab at that.
Sure. I'll sound like a broken record, but I think it's more the underlying fundamentals than the very recent things. And a couple of quick comments that sort of relate to that on some things that have been said. I do think we are seeing a tremendous reurbanization of the population in the United States, and that has a big effect on real estate. It has a big effect on automobile sales, the rise in Uber and things like that. So there's a lot of shift that the economic data, gets confused by as things change. I also want to pick up on just one thing Steve said, because it's relevant to this question. When we talk about growth, a lot of times people forget the variables that change very dramatically from the period they grew up in or analyzed. And so, if you look back as the baby boomers entered the workforce, you had the largest increase in working age population in the nation's history. If you look at, what drives economic growth, it's, hours worked and productivity. So with a huge increase in the workforce, you can get growth out of the hours with just moderate productivity. As those baby boomers get to our age, unfortunately, and we keep working, but we don't know for how much longer.
We just have to continue getting paid.
Yeah, that's right. But clearly we are not going to have that anymore. We have a big decline in working age population. Maybe we can hold on to the participation rate a little bit longer, but that means growth has to come from productivity. There is no, and so in a lot of these policy debates, when we talk about growth, what Steve was saying is dead on right. If we're not focusing on how to drive productivity, and one quick one, I'll get to this, and I'm sorry, is one of the best ways to bring back some manufacturing is to do it as a region. The North American continent has a tremendous opportunity with what's happened to energy supply, with what you can look at the disparate populations. You just take that a factory for autos that was mentioned comes to Mexico instead of Korea, 50% of the content is going to be produced in the United States. And it's going to be somewhat higher end jobs, although somewhat automated, et cetera. But there's no way you're getting that plant back and you're going to lose that 50%. Plus, you have the growth in incomes in Mexico, you have a higher percentage of your exports to what their consumption is going to be. So we need to embrace North America as a competitor. On animal spirits, let me just say quickly, if you looked at an economic textbook at a 20-year period where corporations were seeing their top lines grow 3%, their margins expanding so their bottom lines were going to 5 or 6%, and their return of capital was buying back stock so they were growing at 7 or 8%, if you said, what do you think comes next? You would say a tremendous period of disintermediation. Yeah. And so one of the reasons we don't have capital, businesses have gone to a lot of mature business models have been, sitting there raising margins and pulling out capital. That's a trend. And if you look now at the market, the 5 largest companies in market value are all disintermediating companies. So Amazon can spend a lot of money, which it does, but the entire brick and mortar retail sector is not spending much money to build new plants. So the old business models don't have a lot of places to invest, and you're waiting for the new business models. The last piece of the equation is that what would make up for that would be small business. We always talked about small business being the engine of growth. Well, for the last 10 years, small business has not been the engine of growth, and that's a lot of factors, but a big part of it, in my view, is regulation.
Thank you very much. Others want to weigh in on this?
On the asset side, technology not only makes people more productive, it makes assets more productive. And then you've heard about the sharing economy. I mean, that's another big new trend, and that's making assets more productive. I mean, at Visa, we've certainly not been holding back on spending. We're not a capital-intensive enterprise, but even our capital spending, costs of technology are dropping, and you're able to utilize the technology a lot more. You can make it sweat harder than you because of new technologies than you could before. So, for all the reasons you heard from Alan, I think what you're seeing is the right kind of resource reallocation, right? Going to areas where there's just greater productivity from areas where there's less.
Please, Steve. Yes.
Let me say 2 things. First of all, on the whole question of technology, automation, whatever you want to call it, there was an economist who said back in the 1980s when computers first became prevalent, who said, you can find the presence of computers everywhere except in the productivity statistics. And we're in a little
Samuelson, by the way, Nobel Prize winner.
I thought it was Solow, but okay, we can debate that one later. But in any event, now I lost my train. I got it. In any event, we're in a little bit of that period now that everybody talks about productivity and sees very real examples of of technology and real examples of where technology helps their own business and makes them more efficient. But the fact is that when you look at the productivity numbers, they're really terrible. That we've had spurts of productivity growth in periods like the late 90s, But for the last few years, in a recovery, when you would normally expect to see more productivity growth, we've actually seen very meager, and that gets back to the point Alan made, that growth, economic growth, ultimately a product of two things: how many hours and how much productivity. And so if productivity isn't growing, the economy isn't going to be growing that fast, and that is very much the situation we're in now. So we have all these conversations going on about robots and technology and AI, but the fact is that we're still adding these 200,000 jobs a month because the economy as a whole is not that more productive. And so I would also, while agreeing, I think, with pretty much everything else that was said about capital goods, I would put one more piece into it, which is that when you have a relatively slow-growing economy, relatively low demand growth, there's really not that much incentive for a company to go out and build a new factory or to go out and build a new distribution center, go out and build a new anything.
Exactly.
And so that, in my mind, is why you've seen companies holding back. And there's certainly tax reasons and regulatory reasons, but that is probably the key reason why companies have been holding back on capital spending in the U.S.
And Ross, one thing on that point,
please.
which probably transitions to where you want to go anyway, because Steve and I have talked about this. One thing we can say, though, is that there's been 2 periods of increasing productivity above trend in U.S. financial history. Both of them rode the back of an infrastructure wave, right? One was post-World War II with the build-out of highways and everything else, and one was after the 90s where you had the build-out of broadband. So the talk about infrastructure, unfortunately, is very bogged down as to how to do it. But if we could ever, the United States used to be measured by the global organizations as having infrastructure in terms of countries ranking on infrastructure support of the ability to do business. We used to rank in the top 5 every year. Latest ones, we rank something like 25th or 26th. And so you could make the argument, and this is debatable, that infrastructure that you build now, since it would be more replacement than new, might not have the same productivity kick. But it's clear to me that if we got an intelligent infrastructure building project, that would be very helpful to real wages and productivity. And if we could get that focused on and done, it'd be really positive.
How important could business tax reform be in helping animal spirits return? I mean, Steve Mnuchin talked about this yesterday. I was on a panel about business tax reform. But if you're sitting in a corporate boardroom, how much does that sway how much you're going to invest and where you're going to invest it? What difference could it make? John, maybe?
Well, first of all, let me comment to what Steve and Alan said. I think that the corporate boardroom's focus is a little bit different from just about the investment. Everybody wanted to focus on growth, but the earnings is very important. And I think the market is, first of all, we have abundance of cash in the market. So the market is chasing the investment into stock. And so if you're the CEO of a company, as a public company, you want to not disappoint the shareholders. So what you're doing is to try to squeeze the profit out more and more and more. And you could use the word productivity, you could use the word whatever, but at the end of the day, you could see that a lot of major companies that while they're growing their top line and they're growing the bottom line, they're cutting back people. So we've got to be careful about, I think the market is a big influence of the behavior of corporate America, or maybe the corporate or the global 2000 or 5000. So having said that, everybody's focusing on growth. And the growth usually now in this day and age, doesn't matter what business you're in, you're going to have to break your old model in order to grow. And the market reward the breaking of the old model. And I think the corporate room is going to be talking about what are we going to do different? How do we make sure that the competition didn't disintimate idiots, the current business? And that's one of the toughest things for management is to say, I'm going to let go of the stuff that works ahead of the fact that other people are eating your lunch. So that's I think what the corporate America's boardrooms are all talking about.
If we were able to marry a corporate tax rate reduction, maybe move to a territorial tax with a kind of one-time repatriation fee on earnings held abroad and invested that in infrastructure, is that a way to maybe seek some bipartisan perspective on tax reform? Steve, I'd like to get your perspective on that first. If I put the plan together, and I've written it for various other people, past administrations in the Senate that married them together, been lots of proposals, it hasn't been done. But if the Senate Finance Committee be willing to do that, the Trump administration went along with it, would it get a single vote in the Senate from the Democratic side?
Okay, so a couple things about that. First,
That's a loaded question, I'll admit. But
well, not that loaded. First of all, just on something John Chen said, I do hope that Wall Street is getting companies to produce higher and higher profits. That's kind of our job and a part of the capitalist system. So we would like you to be more and more efficient and produce higher and higher profits and so on and so forth. Look, on the tax system, I think even within Democratic circles, which, just in the interest of full disclosure is more my side of the fence, I think there is a broad recognition by sensible people that the corporate tax system is totally broken and that it is creating all the wrong incentives for companies in terms of where to locate factories, indeed where to even locate their headquarters. It taxes different kinds of companies at hugely disproportionate rates. If you're more of a domestic company, you might be paying the full rate. If you've got a lot of overseas operations, you're paying some fraction of that. It is about as bad a system as you could design if you tried. Yeah. Secondly, we are in a race to the bottom on corporate taxes with other countries. We now have a slightly higher corporate tax rate than France. We have a substantially higher corporate tax rate than the UK. We have a wildly higher tax rate than than Ireland, and some other places that are trying to obviously steal our jobs. And it's a very unfortunate state of affairs because I believe corporations should pay their fair share, but you also have to be realistic and recognize you're in this race, and we should deal with that. Number 3, or whatever I'm up to, I don't personally think the repatriation piece of this is as compelling as some other pieces of it. Apple has $250 billion of cash. 90% of it is abroad, but that still leaves $25 billion of cash in the U.S. They have enough cash to do what they want to do here. We have forced them into this weird situation where their money is sitting probably at J.P. Morgan in London instead of J.P. Morgan in New York. But at the end of the day, there's no shortage of capital in this country to do worthy projects. So that piece of it would be part of a deal, but not necessarily, in my mind, the most important one. I agree completely with Alan. I think infrastructure is absolutely critical. And then to get finally to your question of could you make such a deal, in a normal world, you could make such a deal. You would find people on both sides who would compromise. We are living, not to break the shocking news to anybody, in an unbelievably partisan environment in Washington as well as elsewhere. Do you know that the 1986 Tax Reform Act was passed 97-3 by the United States Senate? The idea that we're going to pass any tax bill 97-3 in the United States Senate, unless it's just like giving Christmas presents to everybody, is very hard to imagine. And so I would love to see something like that come together. There have been many conversations, even going back before the election, between the two sides, between rational people on the two sides, about coming together on something like that. But there are also absolutists on the two sides. There are people on one side that would never give corporations a tax cut if they had their choice. There are people on the other side that don't believe in spending money even on infrastructure. And so I would handicap it as something less than 50-50, but there will certainly be efforts and should be efforts in that direction.
Yeah, coming back to the corporate tax rate question, as someone who's sort of a global company paying taxes all over the place.
You do pay them, though.
We pay a lot of them. Our tax rate is about 30%, so we are a significant taxpayer, unfortunately. The fact is that, as Steve pointed out, you have to look at taxes in a global context because it is a global world today, and I think as Tom Friedman pointed out, the world is flat or whatever, and you have lots of options as a global company. And the US tax rate, while it may have been one of the best, has become one of the worst. And so from a very simple standpoint, when you take the tax rate down, it means companies have more cash available to deploy. It also means that the investments you might deploy them in the US, for example, the same project on an after-tax basis now looks more attractive. So not only do you have more money you can deploy, you have more things that can produce a return. It can be nothing but good from that standpoint. And then if you believe that a reduction in the tax rate will cause some economic improvement and some growth, whatever people's views on that might be, that's icing on the cake. And then some people criticize that by saying, well, corporations will just give it back in terms of buybacks. Well, That's if they're doing their job right. They will invest as long as there's a good return. Otherwise, the right thing to do is to give it back to shareholders, which it doesn't mean it goes away. It goes back into the economy, right? It either goes to other companies that need the capital, or it goes to consumers who can spend it. And then in terms of repatriation, we do have, and we're not Apple, but we do have a fair amount of cash overseas because of some of these disparities in tax. And it's a loss for the US. There's no question whatsoever that this cash is not very well deployed by companies because it sits overseas. And it would, in many cases, come back in one form or another. So we think actually some kind of territorial tax system that is fairer would be a big benefit to the U.S.
Alan, please.
Yeah, I agree with everything. Look, if you get people in a room and talk about our corporate tax system, there is nobody that doesn't think it's broken, right? And one other piece to this, we do have the highest corporate tax rate in the developed world, but we have our tax collections from corporates as a percentage of GDP are roughly flat and at very low levels. So we actually don't collect that much revenue from a very bad tax system. Fixing it would be fairly easy if you just said, let's just fix the corporate tax system. But nobody wants to fix the corporate tax system without getting into overall tax reform, and that gets very bogged down. The main issue, my opinion, and there's been somewhat of a break, the main issue has been saying the small business lobby has said you can't fix corporate taxes without fixing LLCs. Now, LLCs and pass-throughs got created in the first place because the corporate tax system was so bad. So now they're saying, but if you fix that, you got to fix me. So the latest proposal, so the way that was being driven was there was a drive that said whatever you do with the corporate tax rate, which usually is in a double taxed entity once you pay out the dividends, you have to do for pass-throughs that are you have to do for the highest personal tax rate. And so that, that's a 4 to 5 times revenue differential if you cut those rates that then becomes almost impossible to make up. Now, they have in the latest proposal said they're only going to do that for pass-throughs, not for the highest rate. There's a lot of issues. I think you will see things coming out that make it harder to say you're an LLC just because the rate went down. That's a step in the right direction, but all the talk about corporate tax, it would be very easy to fix. I'll make one other point, just for people to keep an eye on. When you look at long-term trends in tax revenues as a percentage of GDP, we've had a relatively constant number on that, let's call it 16 to 19% or so. In that makeup, there's only one area of tax that has been rising as a percentage of GDP, and that is payroll taxes. And again, that's because of the demographics. Payroll taxes are about the amount of people working. So if we don't try to come up with an intelligent reform of our tax system, then you're going to have the working population, which is smaller, need to carry more and more of a burden of what's going on, and it's just not sustainable.
All right. Anything else on corporate taxes? All right, let's move back to the trade area. If I could have slide 27, I did a little homework on this, so I need to show it. I used to spend a lot of time working with large macroeconometric models when I worked at Wharton Econometrics, and I still play around with them from time to time. So I was trying to demonstrate a way that showed that how closely the U.S. is integrated with the Mexican economy versus China, for example. So this shows you for each 10% increase in exports from Mexico, how much it boosts the U.S. economy. So almost 0.1% for the U.S. GDP boosted by a 10% increase in Mexican exports. In the case of China, substantially less than with Mexico, not as integrated in the supply chain. And then if you look at the other chart, slide 28, it shows what happens, slide 28. Yeah, this shows an increase in income by 10% in Mexico. What happens to U.S. GDP? So a 10% increase in Mexican income increases U.S. GDP by 0.1%. So fairly strong relationship. So the point is this demonstrates some of the discussion earlier in the integration, especially in the auto sector. My understanding is that the average auto part crosses the Mexican-U.S. border 6, 7, or 8 times, and if you throw Canada in, it's probably 12. So My question is really provide some further color on this, some examples of just how people don't really think about how improvements in the Mexican economy and trade boost the U.S., and it's not a zero-sum game.
Sure. For example, the airplane, the Bombardier here outside, is called the NAFTA plane because it's another example of one plane crossing the borders. It's also very interesting how the NASCO corridor is connecting Canada, Mexico, and the US, and is more than 4,000 kilometers long. And these distances, I would love also to put into perspective that the distance from Tijuana to Laredo in Mexico is the same distance, the borderline, than the one from Madrid to Moscow. In such a distance, in such a line, there are almost 1 million people crossing a day, 300,000 vehicles, products, services, and this is the number one cross-border worldwide. Every day you see this movement, these opportunities, and if you take a comparison, Canada and the US buy more from Mexico than from Japan, Germany, and Spain combined. But also, Mexico buys more from both NAFTA partners than from China, Japan, and Germany combined. This means a lot of goods traveling, not only consumer goods, as you said, also parts, auto parts, aerospace parts, also food. Many industries are related. This 40% of the content of Mexican exports that they were in the US originally manufactured. Then if you buy something, the made in Mexico logo, you're buying 40% American. This means we are really integrated also with Canada. And if you buy something made in China, you're buying less than 2%. You can see this also with GDPs and all other impacts. Only 2% that was originally manufactured in the US. This integration brings us really to this 200,000 NAFTA export-related jobs annually in the US. And this means that the trade between Mexico, US, and Canada really is bringing more to the economy than subtracting from it.
John, let's switch a little bit. You can talk about Mexico too, but I wanted to spend a little bit of time talking about a relationship with China. The meeting between President Trump and the President of China seemed to go fairly well. China wasn't declared a currency manipulator. I mean, what should the U.S. approach be with China?
I'll answer the question. I mean, first, it seems to me that we spend quite a bit of time on a number of issues, and it's kind of feel like I have a bigger question. It's really what we're all talking about is globalization in trouble. Right. I think we're all talking about that, and I feel like right now when you look at NAFTA, we're picking out singular areas to want to optimize for various countries. But if you look at the NAFTA as a whole, it certainly has benefited all citizens of the free countries. And so we got to be a little careful before we throw the whole thing away and just think, it will be an interesting topic. I mean, a lot of you are a great researcher. It will be an interesting topic to write whether globalization itself is in trouble, because we're kind of hitting on the fringes of that. Regarding to China, when President Trump was campaigning, and after he won, there was a period of time that the Chinese people were extremely excited. And because, after you could call it whatever it is, the United States foreign policy as related to China and APAC, in certain way of encouraging growth and then in the same time doing some level of containment. And that strategy has been in place for, let's say, the better 20 years. And China obviously want to take a bigger role in the world scene, and rightfully so. And we ask them to, by the way, we constantly ask them to take a more active role in a global scene. And China's ready to do that, and so they believe a President Trump will change the narrative quite a bit, and they're very excited. Of course, once the moment that President Trump gets into office, the first conversation is about currency manipulation. So, and that I'm glad that, by the way, let me comment on one thing. I think we need to. President Trump did one very good thing. I think his economic team and national security teams are just top notch, in my personal opinion. I mean, some of the people I know, some of the people I don't know, just know by reputation. But I think everybody agrees that he gets some really good substance surrounding him. And so if he would listen to their advice, which sound like it's starting to, and things will go in a better direction. So China has been quite mute regarding that all these little saber rattling thing. You remember the whole incidence of phone call to Taiwan. Yes. So that changes the entire policy, foreign policy standing of our country. But so I think where we are right now is the right level of engagement. I think there's an economic dialogue going on, and there's strategic dialogue going on. I understand that the Trump-Xi meeting, went very well and set those 100 days plan after the meeting. So I'm very hopeful that we're on the right path with them. And China not responding to some of those, troubled statements in the past, or responding rather mute to the troubled statement, is actually a good sign.
Good. Let's talk a bit more just on what can be done to bring back middle-class jobs. I mean, what would you guys like to see the Trump administration focus on that it maybe isn't focused on so much in terms of creating middle-class jobs rather than bringing them back? But what else would you like to see them focused on in terms of policy prescriptions, regulatory changes? What aren't they doing that they should be focusing on?
Well, I think I'd say a couple things. First, I think with respect to fiscal policy or the budget, they have been focused obviously on tax cuts on the revenue side, and some kinds of tax cuts could be helpful in creating jobs. I'm not sure that tax cuts of this sort that are so massive and so across the board and so tilted toward the wealthy are the ones that at least I would pick if I were trying to attack the problem that you described. But secondly, I believe, and there may be some disagreement about this, that there are things on the spending side that can also help create jobs. We've talked a bit about infrastructure. The president has promised an infrastructure plan, but we haven't seen one yet. But in areas like education, in areas like training, I thought Jamie Dimon made a really eloquent case yesterday for the earned income tax credit and what it does to keeping people at work and bringing people into work. There's a lot more that I think government can do to help without getting into stupid programs and wasteful spending that is what government is also attacked for. But I don't see a lot of interest in that at the moment. Can I just say one thing about China, because it's just on my mind, and Mexico? I think first of all, I think globalization has been a big plus for almost everybody in this country, not necessarily absolutely everybody, but for the country as a whole, it certainly has been. There's no question it's under attack now. There is, I think, a fundamental difference between Mexico and China that's worth pointing out, which is, to my knowledge, Mexico has never been accused of violating one provision of the NAFTA agreement. Everything they've done completely by the rules. China, where I spent a fair amount of time, and I suspect others on this panel do as well, breaks all the rules. And it is the most protectionist, the most mercantilist. They're not manipulating their currency, but they're manipulating everything else that has to do with trade and investment and a level playing field for companies to compete. And I'm not saying we should put 35% tariffs on them or close the door or whatever, but before we fall completely in love with President Xi and the Chinese, I think we should recognize that they have actually cost a lot of jobs here, and not always by playing by all the rules.
Alan?
One thing on that is, if you were starting from scratch and you wanted to deal with the China influence, you would come up with something like TPP, where the rules were getting a whole bunch of nations to say, these are the new rules we're all going to play by, and that would be turning to China. I think the next opportunity of that is actually NAFTA. If we improve NAFTA, bring it up to modern standards, anything that was done 20-something years ago can be upgraded. That is one of the opportunities. The other thing on this whole issue of jobs, I think the government sector, some of the things we've talked about, a lot about job training, especially working with community colleges for job training and programs and things like that. But at the end of the day, the corporate sector needs to take on certain challenges. And we've had on some panels in the past, for instance, people like Walmart. We talk about wages a lot. We don't talk about the impact of some of the work rules and things. And so a company like Walmart has figured it out, that if you ask a working mother, if you tell her Tuesday night, we'll let you know if you have to work Wednesday morning, how does she get daycare, how does she get all these things? So I think we're beginning to see that the corporate sector is realizing that if they want productivity, they can't stress out their workforce as much as they do in the middle class, and that there's a lot of levers that could be pulled where they could get more productivity out of it. The last thing about trade, I think that Tom Friedman said one time, he said, all of the people who are negatively affected by trade are hyper aware of it. All of the people that benefit from globalization and free trade actually aren't aware that it happened to them at all. And so I think there's something about that in what both the corporate sector and the government can get to. One of the examples I use, I say to people, the big thing on Broadway now is Hamilton, right? And so if you go and just think about Hamilton, if the Jeffersonians had won out on the way the United States should have come together with rules about, interstate, but there's no way plants, you would have had the governor of New York or Michigan saying, we're going to get those jobs back from Alabama. We're not letting plants go over there. But we were a country that said that we could see the benefits to the country of allowing free trade and on certain rules and principles. We also had ways to backstop and support the people that were affected by trade, at least temporarily, in adjustments and things like that. So I think we've got to do a better job of letting the beneficiaries know they're benefiting. And then I think we have to do a much stronger job of finding ways to support the people that are affected, because that is significant.
Right.
Yeah, just a couple of points on that. I know our chief economist, whenever I ask him these things, likes to point out that if you look at people who are employed, and you probably know this, wage rates are going up nicely. So anybody who's been employed a year has seen a 4.5% increase in wages in the last year. Yeah. The other thing he likes to point out is there's more than 5 million job openings that are unfilled. So there's a huge skills mismatch. And there are no easy fixes to that. But unless we deal with that, you could be, you could have a problem diagnosed, which is we have this issue, but the prescription may be the wrong one. And if you apply the wrong prescription, you can make the problem worse. So, and it's a very real problem. I'll just give you something that just happened. In the month of February, the IRS didn't send out tax refund checks fast enough. It was delayed by a couple of weeks, so $60 billion didn't go into people's pockets. These are people who file taxes early as soon as they get W-2s. We saw an immediate impact on debit card spending on everyday items, whether it's supermarkets or pharmacies, and you've heard some of this from retailers. So there's a real issue here. And unless you deal with this issue of how do you get these people to have skills that get them jobs, it probably doesn't solve itself. So, I don't hear much being talked about on that front.
Right. I just wanted to get a sense from everyone on the panel how much they think that the delay in getting the Affordable Care Act repeal and replace through the House might cost the overall Trump agenda in moving through Congress. How much of an obstacle is that? Can they still recover?
I actually think it might be a strategic mistake to move the Obamacare repeal effort before we get the tax thing done right. I think as we go into the election or midterm election, the administration needs to establish some level of credibility on moving the agenda and the legislation. I think it's set back quite a bit, and now we need to get the economic part of it right, or the tax reform right.
Is it possible that if you don't get something on the Affordable Care Act repeal, replace out of the House, that there'll be pressure to perhaps change the leadership on the Republican side? Is it still a bit early for that, or how much longer does it go before there's that much pressure?
Look, I worked with Paul Ryan on the auto rescue. I think he's a really good guy. I think he's smart. I think he's trying to do all the, he's in that job for all the right reasons of trying to make things better based on his philosophies and his views. But unfortunately, I think you'd have to not give him the highest marks for how things have unfolded. Look, you can't, he's got a recalcitrant caucus, and you can't necessarily get them all to the right place at the right time, but to sort of set a vote and then cancel a vote and then go back and go. Some of this does not reflect, I don't think, honestly, the most sophisticated management of the situation, but it also simply exposes the fault lines. You've got fault lines in both parties where you have people in the Republican Party that go all the way from the Tea Party, the Freedom Caucus, which is the Tea Party, all the way over to what they call the Tuesday Caucus, which are pretty moderate fellows. And in the Democratic Party, they have something, a split that's something similar. So I think what this has done is really expose the difficulty of getting legislation done. And I think you'll see it also come to pass to some degree with the tax bill. Now, the Republicans can pass tax legislation if it's constructed a certain way with 50 votes in the Senate as opposed to the 60 you need to overcome a filibuster. But as we saw with the health care bill, the Republicans couldn't get an agreement within their own caucus, let alone with the Democrats. So I don't know I'm not saying that what's happened to the health care bill necessarily is a cause of the problems they may face with tax reform, but I think it's a symptom of the problems that still exist on Capitol Hill, even with Republican majorities, of getting significant legislation done. So I think it's going to be a long, slow, pretty ugly, and uncertain process.
Okay, you heard it here. Alan?
I agree with a lot of that, but I actually see some other sides of it too a little bit. I actually think not being able to jam through a Republican-dominated House bill that was already pushed a lot of. We talked about how some of the more balanced advisors are getting a bigger voice in the White House, and I think the failure to get that passed has positive silver lining for who's got a voice. I do think Paul has got, I think the divisions in Congress, where we got the Tea Party or the Freedom Caucus on one side. I've heard recently that we're going to see the Democrats divide, and on the left there's going to be the Herbal Tea Party. I don't know if that's going to actually happen. But I think it could drive more things. Now, one thing, technically, it is extremely complicated that they can't get a tax bill through reconciliation until they do ACA first. Right. There's a lot of very technical things there. Personally, I think they're going to get ACA done because I think there is so much heat. But the last thing I'd say to what Steve said, the breakdown, it is way easier to spend 6 or 8 years screaming to your voters that the other guy is so messed up and he's doing such bad things to you, and if we ever get in, we're going to fix it overnight. It's way more complicated to get in and actually do something instead of rail against. We've got to do something about primaries and things like that because we have a broken Congress, and this is just one sign of that.
Can I just take the under on your ACA prediction? I think the problem is that a bill that can get through the House, and there are bills, including this MacArthur one that is being considered now, that might get through the House, can't get through the Senate. Right. And I think that's where
vice versa.
Yeah.
Right.
But they could use reconciliation in the Senate. And that's true.
Well,
it's an important step to allow them to, it's very technical, but on a budget bill, they could then get tax done on reconciliation.
They can do, first of all, there's some question about whether they can do reconciliation on all of the ACA because it gets technical there. But even if they can, getting 50 votes in the Senate on a bill that the Freedom Caucus is going to vote for is going to be tough.
I agree, it's tough.
All right, let's get to a wrap-up question and kind of bring this all back into focus. What pieces of the Trump agenda will be passed by the end of 2017? John, you're first.
2017?
Yes, that's this year, correct.
Where we are right now with all the politics that's going on, the dysfunctional congressional thing, I don't know anything that will pass before 2017. And we're now managing the country by executive orders.
Right.
What's
the perspective from Mexico?
NAFTA modernization. I'm sure that we will have a new NAFTA.
By the end of 2017?
The beginning of the negotiations. But you have to,
Okay.
to launch.
We'll have the start of the
Exactly.
negotiation.
You're talking past, right?
2007.
No.
Nothing
Okay.
passed, though.
No, so it's not. It's not passed.
Vasant, what do you think is anything going to get passed?
Yeah, I think low corporate taxes, because the business case for that is pretty strong, and something on repatriation seems possible.
Right. Steve?
I think there will be a tax bill, particularly on the core, at some point. I would say the odds of getting it, some point being the next 2 years, I would say the odds of getting it done in 2017 are less than 50%. And I think the odds on the ACA are a good bit less than that.
Alan, you get the last word.
Yeah, I think there will be an ACA modification, not anything like the complete overhaul, so it'll fit reconciliation rules that they'll be able to declare victory on, but still leave the law mostly in place. And I think there's a slightly better than 50% chance that they will actually get tax legislation passed.
So maybe 55%.
Through reconciliation, yes.
Okay, very good. Well, please join me in welcoming our outstanding panelists. You heard a great deal of perspectives, and hopefully we've enlightened you. Thank you.